Hi everyone. Yeah, all the team are here. Good evening to everyone. Uh, Tonight, Springtime is covering another webinar regarding the startup fundraising perspective and the valuation issues along the way what entrepreneurs are facing. And today we have Professor Mizian Lasfer. Is actually a professor of corporate finance in more than 30 years in a business school, City University of London. And actually, he's a guru about the finance, so we are honored to have him with us. And also, we have Katarina, and she's an entrepreneur and investment and strategy advisor and consultant. So she advised or gave consultancy to startups. So welcome everyone. And yeah, so it's yours. So let's start with a kind of a first question, which is, I think, I think it's important to startup or entrepreneurs. So what do you think? How important is raising capital in the development of startups? Actually, Professor Mazian, the floor is yours.
Okay, thank you very much, Abdelkader, for this introduction, and hello everyone. It's really good to be here with you. Unfortunately, well, I know that it is a very big opportunity cost there because there are some good matches tonight. So for those of you who like football, but we'll try really to keep it very short, and hopefully you will benefit from this discussion. Obviously, we heard again unfortunately the Maradona passing away this afternoon. So again, for those of you who like football, so it's a bit sad, but what can you do? It's life. Okay, so thanks a lot again for joining us. So what we are going to discuss today is much more about the financing of the startups, but we will include also a set of other factors that are related to this the financing. So for your question, Abdelkader, when you think about the startup, a startup is really kind of generating an idea. So you have an idea and you want to develop it. The financing is the backbone of that idea. So because having an idea without being able to finance it, you want to be you want to develop it effectively. So it will just stay as an idea without really emerging and without coming up into the market. So we can consider that the financing of a startup, or in fact any business, is kind of very, very critical. So now there are a number of questions obviously that arise from there. What type of financing do we use, etc.? And that is really what we are going to discuss today in this webinar.
Great. So do you want to add something, Katarina?
So I would so good evening for a start. I didn't get to say good evening. Good evening. I'm very happy to join. It was a bit unplanned, but it's great that I can be here with a professor and you, Abdelkader. From a more practical point of view, I think the professor is absolutely right. It's really the backbone of your idea. From a more practical point of view, I would say the question is really how relevant is financing in the current stage of the development of your company. And is it the right thing to do at that point in time? Or do you need to wait? Do you need to generate revenue? We'll get to that a bit later. But for me, there's also a timing constraint to it.
All right, great. Thanks, you, Katarina. So the other important question, which is where do startups raise capital actually? Where they can go to, and to where and who they can approach to raise their capital.
Okay, so raising capital is obviously implies that there is a financial system. There is what we call an ecosystem in finance. So without really having the counterparty, who are the people who are going to provide you financing, then you cannot. I mean, you want to raise capital, but then you don't have the where to raise it. So effectively, where the place where you are going to raise capital will be the financial market, and more specifically is the capital market, because financial market might be very global. It might include derivatives market, it might include other markets, but what we are focusing here is much more a capital market. So a capital market whereby you as the entrepreneur, you will have the choice as to the methods of financing that you use, because we are going to explain them in a minute. Those financing methods are not going to be random. You need to select them strategically. You need to know which one is going to be convenient for you. So if we have, for example, a financial market where you have only bank, you won't progress, because the banks are just going to be, they will finance you up to a certain point, but obviously they cannot take too much risk. And also for you as an entrepreneur, you don't really want to go and just finance yourself from a bank, because you are increasing your financial risk. So consequently, for your question, Abdul Kader, where you raise this capital will be in the capital market. That will give you the opportunity to select the sources of funding that are going to be required for your specific company, and for because your company will have different stages in its life. So in that life cycle that we are going to explain in a minute, you will be able to choose the particular source of funding that you are going to have for your business, and consequently you need to find the people who are going to provide, or the institutions who are going to provide this form of funding. So globally, for this question is that we need a financial ecosystem whereby that offers the different possibility of financing different businesses. And we'll be talking about this. So you need to have, for example, the venture capitalist. You need to have angels. You need to have obviously debt. You need to have maybe bond market. You need to have the leasing market, etc. So all those are going to be very critical and very important for your decision to choose who to contact. Okay. Cannot hear.
We cannot hear you.
In a nutshell, it's kind of an ecosystem consists of a government, private, and individual. So all this entities should work together to build this ecosystem, so people can approach and can ask for raise capital.
Well, government, I think we can keep it aside at this stage, because government is really for me personally, government is an institution that will provide the other facilities, like for example the infrastructure facilities, like facilitating, for example, the roads, the kind of the transport, etc. But I think at this stage the government, we can keep it aside. What I meant is really kind of more individuals and private institutions that are going to provide those funding. So those individuals, it could be some people like the wealthy individuals who succeeded in their business before, and those are what we are going to refer to as the angels. And the institutions will be, especially for startups, will be what we refer to as the venture capitalists. So venture capitalists, there are kind of individual companies, independent companies. They get funding from the different kind of providers of those funds, like pension funds, etc. They invest in those venture capitalists, and the venture capitalists will invest that money in those businesses that they will select. So that is really what I meant. And then obviously the banks also, they would provide some funding, because if you want to finance your short-term working capital, your operating activity, then you can only rely on bank lending, and we'll see it in a minute, because you can borrow on short term. But if you want to finance your long-term prospect, your long-term growth, the only sources probably that you would recur to will be those venture capitalists, the angels in the form of equity, and long-term debt in the form of debt.
Mm-hmm. But I would add, in any case, entrepreneurs or startup, they need to bootstrap in the early stage. They need to raise capital from what we call it the triple F, family and friends and fools. So it's all about the environment. They need to raise it so they can show a good intent to venture capitals or even angels. So they're serious about the business and their project, right?
That is an excellent point. When you are a startup, the big problem of smaller companies and in particular startups is the what we refer to as the information asymmetry, because the providers of funds, they don't know too much about your company, because you are not generating profit, you are relatively small, you are very, very young, and consequently the information that they would have about you will be very, very small. So they wouldn't know too much about you. So therefore, at that very early stage, you are probably going to tap into the people who trust you, and those people who trust you are probably members of the family. So you can get some funding from your parents, from the people you know, your friends, etc. At the same time, this funding that you get from your parents or your friends will constitute what we refer to as the certification, in the sense that when external investors, like for example the angels or venture capitalists, they know that you have obtained this money from the parents, etc., it means that there is some certification for them, there is some a guarantee for them. So earlier I was talking much more at the institutions and the people who are totally outside your company, but you can also get some funding from those individuals that are very close to you, who can trust you. Because as I said, when you are a startup, the big problem that you have there is the fact that you are not well known, and therefore the information asymmetry between you and those providers of funding is very, very wide. And you need to reduce it. There is also this issue that if they see that other people, that you brought in some money yourself, your parents gave you some money, your friends gave you some money, they will trust you that you are not going to take the money from those angels or venture capitalists and then go and run away. So you are going to reduce what we refer to as the agency conflict, effectively, that they give you the money and they know that it's going to be used effectively in the company. But they have also other ways of control, of monitoring you. That's what we are going to discuss a bit later on.
Sure, great. So in general, what are the source of funding?
Okay, so if you allow me, I'm just going to share my screen because I have quite a lot of kind of explanations to do here. There are so many issues to discuss. I don't want to lose the audience, and obviously the people who have got some experience, some knowledge in these issues, then I hope I'm not wasting their time, because we get into some things that are slightly complicated. But for those of you who do not have kind of knowledge, I hope you will find it useful. So I'm just going to to share my screen, and I'm going to put some to explain those issues. Okay, so if you look, what we refer to as in accounting as being the
hold on, give us a
the
moment.
balance sheet of
Okay,
now it's showing. It's good.
Sorry, okay. Sorry. Okay. So you have your company that has got some assets. Is that fine?
It's fine. It's fine. Go ahead.
So those assets you need. That's fine. Yeah. So incidentally, I just put here my email in case you have any questions to ask afterwards, because the time is really very short. But I'll be happy to help on this on those issues. So when you look at your company, you look at what at the balance sheet that gives you a snapshot of what your company has as assets. So you probably have some fixed assets that are buildings, or that is your house if you are just working in your house, or your room. Maybe you can put even just one room as being a kind of part of your business, of your startup. For some, in particular in 2000 period, they started their businesses in the shed, just in that small hut. So they started their businesses, and that is really what they put as a fixed asset. So it's the value of that hut or the shed. Then you have the working capital, is what you use for really kind of the operating activity. It's mainly what your current assets minus your current liabilities. So But then those assets here of say 1,000 are financed with debt and equity. So the two main sources of funding that you will find can be classified as debt, as either debt or equity. They are not the same. They are totally different, and that is really what I'm going to explain now. The focus on. But at this stage, just keep in mind that your company, which are really represented by those assets, say of 1,000, is financed with debt and equity. There are some businesses that don't have any debt. So especially if they are young, they cannot borrow, etc. So maybe the debt is zero. But usually companies, they always have equity, unless if those entrepreneurs really put the money that they bring into the company as debt, which is, you need to be careful there if you are really venture capital or an angel. So let me just go and explain a bit more the differences between those two. First of all, the types of those sources of finance that you would find. So when we talk about equity, the first thing that probably you need to think of is the money that you bring in, you as the entrepreneur, into the company. So your savings probably. You could add also here within entrepreneur's capital, you could add also here maybe the money that is brought in by your parents, by your friends, etc. So they're probably going to be here under the entrepreneur's capital. Then as equity, you will get some funding from angels or venture capitalists. Those are kind of the providers of equity. So they take stake in your company, and we will explain a bit more how much they are going to take as stake in your company for the amount of money that they will bring in there. Then if you are a bigger company, you grow kind of, you are a big company now, you are likely to come to the stock market, then that equity will be what we refer to as the shares, as the stock in your company there. And finally, you can issue warrants. Really, the warrants that are options that you might give to your shareholders to subscribe for future shares in your company. The debt is can come also in those three main forms. It could come in the bank debt, i.e. you just go and borrow from a bank some money that you need. You could lease some of the equipment that you are going to use, in particular if the bank doesn't trust you too much, they wouldn't give you money. But given that you are a good client, they don't want to lose you. So what they are going to tell you is that suppose that you need to buy a computer. So that computer might cost something like say £1,000. Sorry, I talk in pounds, but you can convert it into whatever currency in the country you are in. So instead of giving you £1,000 and you probably run away with them or spend them somewhere else, they would tell you, no, we don't trust you. But they wouldn't say directly, we don't trust you, but indirectly they would say, no, we are not going to give you £1,000, but we are going to buy the computer that you want and we lease it to you. So effectively that computer doesn't belong to you, but you have got the right to use it. But it will still be in the balance sheet of your company. It will be included there. And finally, you have the corporate bonds that are really kind of issuing some debt in the market. Now, it's important that I'll skip those convertibles, those hybrid, unless if you really want some more details. Sometimes there are slightly complicated, like convertible bonds or preference shares, etc. But really the two main sources of finance are equity and debt. Now, it's important to understand the differences between them, their characteristics. When you think about the finance, it's always what would come to mind directly will be those two notions of risk and return. So the finance is really all based on those two main concepts, risk and return. So when you think about equity, they take higher risk. Why? It's because if something happens in your company and the company goes bankrupt, then the debt holders will be the ones that are going to be paid first. And probably you as the entrepreneur and the other shareholders may not get anything left for them. So they take more risk. Consequently, they will ask for higher return, because there is a relationship between the risk and the return. The higher the risk, the higher the return that they would require. So if you are an equity holder, the return that you would require will be higher. And we will explain it a bit more with the numbers when we do the valuation. The equity is also is long term. So when you issue it, it's not going to be for 6 months or for 3 months. It's forever, infinity. There is no tax deductibility of your dividends, because any earnings that you have will be after tax, depending on the country where you are in. We can discuss this later on. And finally, the equity holders are the ones who control the management there. Now, in terms of debt, it's totally the other way around. Debt has got low risk. Why? It's because debt holders will be paid first. So in case something happens in your company, you need to pay those debt holders first. So that is why we say that companies, when they borrow, they take a risk because of this priority of the debt holders. In terms of return, consequently, the return is lower than the equity holders, and they get their returns in general fixed, a fixed payment that you pay whatever your profit, you still pay the fixed amount of interest there. The debt the maturity is also fixed, because you need to pay it at certain time. It's not like equity; it's going to be forever. You, after 6 months or after 1 year or after 10 years, you still have to pay that debt. It's not going to stay all the time in your company. The big advantage of debt is that in countries where you have a corporation tax, you can deduct the interest from the before you pay tax. So consequently, it's going to be cheaper for you on after-tax basis. And finally, there is no control by the debt holders, i.e. the debt holders would normally not sit on your board, etc., because they are protected by law. So those are really kind of the different sources of funding that you can use to finance your business. And obviously, the choice between them is something that we are going to discuss in a minute.
Maybe we might want to have a short break and take some questions, because I think that's quite a big piece for a start.
Yeah, I think we have a question here from, as you can see, from Samir. The innovation procedure is the field of medical devices the same in Algeria as in Europe?
I can answer that because I'm currently working with a health tech company.
Okay.
So I do not know what the innovation procedure is in Algeria. I just know that for a start, it already differs between the European countries. So per se, I would say yes, it's a different procedure. The regulatory admission of health devices, health tech, is a slightly different one than in the UK than in Germany, for example. So anything related to health tech, medical devices follows a specific regulatory procedure, and it differs from country to country.
Mm-hmm. Great. Yes, thanks, Katarina. Professor, do you need the sharing screen, or it's okay?
Yes, I need to carry on sharing, because that's really what I'm going to explain now, as to when do you use those sources, those different sources of funding.
Yes.
So in other words, we identified them. We identified those sources.
Sorry. One second. Abdelkader, can you take the question out of the screen? Because, yeah, thank you.
Yeah,
that's
so
we can see all the information of the professor.
Yeah. All right.
Okay, so as I said, those sources of funding, you are not going to use them randomly. There are different. They depend on the life cycle of your business. So when you are, I guess that most of you are in the startup stage here. So in this side here, you're probably making losses. I just put here really the blue line here is about your earnings, assuming that you are making small earnings here, and then as your company grows, then you are going to have a higher earnings. The green line is the revenue that you are generating by selling your products. So in general, in fact, even those startups, they may start even lower here. They are making losses at this stage, because they just really, for simplicity, that I put here that they make some profit, but actually they probably make some losses at this stage. So when you make losses, then your sources of funding will be very, very limited, because not many providers of those funding will trust you, because they haven't seen you're making losses. How can I trust the business that is making losses? It's only if I trust you, I trust the future of your company, not what you are generating now. Now you are generating losses, so all my investment will be based on what you are going to generate in the future, and we'll do it in a minute in terms of valuation, and you'll see how it works. So at this stage here, your company is also, you need lots of funding, because you need to grow, you need to pass into this rapid expansion here to grow further. But you have less infrastructure that is going to allow you to get the necessary funding to finance that potential growth that you are going to have. So in general, at this stage, we find that companies, they finance mainly with small amount of debt, and with what the owner is bringing to the company, what the really kind of this entrepreneur is bringing to the company, himself or herself, as well as his or her parents or friends, or so, some people who are very close to him or her. It's really this rapid stage here that you come and raise some money from venture capitalists. That is really the time that you can tap into the venture capitalist, and you get some funding. Probably the angels also would come at this early stage here. At the startup stage, you can get funding from those angels, and we'll explain them in. Then after, when you are really high growth here, you are likely to come to the stock market as an IPO. And then when you are mature, you are likely to finance with debt. But when the company is declining because you want to shrink, your company is too big, you cannot manage it, so you shrink it. Or alternatively, the company is in distress, you are not selling enough products, etc. Then in which case you try to buy back those shares, and you buy back the debt. So it's, instead of issuing debt and equity, you will try to buy them back. So roughly, this is kind of the trend in the financing that is likely to apply for all companies. What I meant from here is that the financing is not homogeneous across those different stages of your life cycle. And if you allow me, Abdelkader, just to give an example about this. So if we take the example of, I like using the Amazon.com, because it's kind of used, well known, but also, I mean, you can, I have examples of many other companies like Uber, etc. But I like this one because it's really the one that tells us exactly the stages of financing through its life cycle. So when Jeff Bezos created his company in 1994, he brought in $10,000 and he borrowed $44,000. A year later, his parents, mom and dad, probably their retirement money or their savings, they invested in him $245,000 a year. Then in 90 year later, he had 20 angels that financed his company with $937,000. You can see that the angels, one characteristic here is that they bring smaller amount of money. So on average, it's about $47,000 that they brought in. So obviously $47,000 per each, but as a 937,000, it's also quite lots of money that he needed. But look at this, in May
Allow me,
26, please go ahead.
if you allow me, Professor, I want to add something regarding Amazon and Jeff Bezos. I want to say that pitching investors is a long process and very difficult and frustrated. Jeff Bezos, before he get this first $1 million, he pitched around 60 investors, 60
Wow.
venture capital and business.
Okay.
So he got his first $1 million. So people, when entrepreneurs, when they pitch investors, sometimes they reach 5, 4, and they said, okay, it doesn't work for me. It's maybe it has something. You need to pitch a lot. You need to a lot of people. You need to pitch them so you can get a few money. So that's it. I want to just add this.
I would
That's
also
a very good one. Please go
Right.
ahead, Katarina.
Yeah, I also wanted to add, not every investor is the right investor for your business. So if
Yeah.
you want to avoid pitching 120 people, you make a pre-selection in terms of what industry your investors are investing in, what typical investment ticket they have. So you make a sort of pre-selection of the people that are likely to actually look at your pitch deck, because otherwise you will really, really, really tire yourself off.
Yeah, absolutely.
That's a very good point, and we'll talk about them more when we talk about how do you do it. So in a
Yeah.
minute, we'll be talking about those stages, and that stage one is very, very critical. That is really where all those issues would come up, and the way you are going to present your company, to ask for funding, etc. It's very, very critical there. So in May '96, he got from two venture capitalists $8 million. So roughly each one $4 million. So you can see here one important difference between angels and venture capitalists is that angels, there are wealthy individuals, there are individual people that succeeded probably in their business, and that is what you mentioned earlier about this experience, probably because they are in that particular sector, and you are going to select them, and those are probably the ones who are going to feel happy to invest in your business because they know roughly the ins and out of the market, and they are going to know roughly how they are going to compute the value of your business, and also more importantly the risk that they are going to take by investing in your business. So they are not totally outsiders to the industry or to the product of your company. They are much more likely to be the ones that are familiar with it. But as I said, the difference between angels and venture capitalists is that angels are wealthy individuals and they invest only a relatively small amount of money. I think it's roughly up to £150,000 in the UK that they can invest in any specific business, any specific venture. Then, in order to get more money, you probably know you probably need to get into those venture capitalists that are going to be able to finance your company with a large amount of money. Okay, there was this question: how to define the levels of financing needs for each period of growth? Are there any rules? Yeah, obviously, what you need to think of is that you need to do financial planning. You need to know how much investments you are going to undertake, and consequently how much it's going to cost you to undertake those investments, and you look at how much money you have internally. If you don't have enough money internally, you need to go for outside funding. So that outside funding is likely to be in the form of debt or equity that we are going to talk about more. So if you are a startup, you need to know what are your investment needs. From those investment needs, you need to know how much do they cost, and then you need to look at where source of funding that you are going to target.
I would like to add something to what the professor says, which is absolutely right. There's another aspect to funding, which is you need to understand how much you need to drive your business versus how much of capital you are willing to give up for the money that you get in. So you really need to weigh the pros and cons of onboarding 2 million versus onboarding 4 million. Is it actually worth to give up share capital to onboard 4 million and push the growth maximum? Or are you better off onboarding 2 million, give up a bit less share capital and push the growth a bit less, but make your own shares more and new? This is like a fine line and fine balance that you need to keep between those different aspects of funding.
Yeah, interesting. Yeah, Katarina, this is interesting. Specifically, because some entrepreneurs they're keen and they are always thinking to raise capital. They push themselves a lot. They don't focus too much on their business rather than raising capital. And the thing is that raising capital is a need. So whatever you need it, you raise it. If you don't need it, you don't raise it. It's not like you buy 10 baguette of bread. If you eat 3, you will throw 6. In capital, the other one will be in debt or in your balance sheet negatively. So it's not something like let's raise $1 million. It's fine. It's good for us. No, it's depend on your need. So you raise what you need, because investor, they will ask you a bit and byte about any expenses and where they go.
Yes, I think that's absolutely right. And I would like to add something. A lot of times you see those announcements on LinkedIn where companies very proudly say we raised this amount of capital and that amount of capital. And by all means, that's totally justified because raising capital is hard work. However, I would like to break a bit the myth of the glory of raising capital. It's not because you raise capital that you have a wonderful company. You have a wonderful company because you have a great business idea, a great team, you generate revenue, and you have a market. Okay, this is what makes your company great. And if you need to raise capital and you do it successfully, that's absolutely wonderful. But once again, if you generate enough revenue, there is no reason, just for the sake or the glory of it, to raise capital. It's like, if you don't need it, don't do it.
Yeah,
That's excellent. That is what we refer to in finance, in what I teach in corporate finance, as the pecking order theory of financing. So you'll start really from your internal funds. The most critical factor here is really the investments that you are going to have. How many of those investments are leading you to growth? How many what we call positive NPV projects? That is really your backbone. Once you have those, then now you look at how are you going to finance them. So you have investment decision here. So once you make the investment decision that those projects are worth undertaking because they are going to allow you to grow, to create value, etc. The next stage is to see what sources of funding you are going to use. The two might be interrelated, but really the critical factor here is that if you have got internally all the money that you need to finance those projects, there is no need to go outside. There is no need to go to seek outside funding, because there are many advantages, but there are also many disadvantages of raising capital from outside. And one of them is what we are going to discuss now in a minute in terms of this valuation of your company. How much stake you are going to give in your company relative to how much money you are going to raise from those angels or venture capitalists. And it's slightly complicated, but I tried to make it easier using the spreadsheet. I hope we will get to it. It's just that stage 2. But let me just carry on a bit about this example of Amazon, and then we can go into those steps of raising capital. So i.e. the process and how are you going to raise this money, in particular from angels or venture capitalists, when the business is a startup, is really kind of young and the small and very high growth. In other words, it's really very risky. You can think about it that way. And then now let's see how this risk is introduced into the valuation, etc. So if you allow me to carry on just on those few steps really of the Amazon.com, how the Jeff Bezos really raised funding. So in May 96, he raised from two venture capitalists 8 million. As I said, they think a lot about this difference between angels and venture capitalists, that if you need smaller amount of money, as I said, something like up to 150,000, you probably better off starting with angels. But if you need a large amount of money for your business, then probably it is worth going to the venture capitalists there. But venture capitalists really come a little bit after this stage of development. Really, when you are, that's what I put here, venture capitalists, it's really this rapid expansion. So as a startup, you are likely to start with with angels and maybe crowdfunding, that if you are interested, we can discuss, etc. But so that's really kind of the Jeff Bezos, how he raised money. Then in 97, a year later, he came to the stock market. The company was listed in the stock market. It was $18 per share, really. Therefore, they valued the company at 438 million. Then there is bonds in 98, a year later, for 326 million. But just before we start this course, we looked at the price of Amazon, and the compute the market value of Amazon. It's 1.64 trillion. So effectively, it is a guy who started with $10,000 And now in 94, obviously, but now is worth, the company that he created is worth $1.64 trillion. And what brought him to that stage is obviously the idea that he had, probably the networking, but also more importantly are those providers of funding. So if we didn't have the angels, if we didn't have venture capitalists, if we didn't have a stock market that is relatively attractive to those companies, if we don't have the bond market, the company would have disappeared probably a long time ago. So it might be created for 1 year, 6 months, and then it will just be just a history. That's it. But still, Amazon, as I said, is really kind of reached this stage of $1.64 trillion through, because there is this financial system, the ecosystem in finance that allowed him to get the funding at those different stages of the life cycle of his company. Obviously, as I said, I mean, not many companies succeed like that. There are many that do not succeed. There is lot of who you know rather than what you know. There is lots of, because it's trust. Who is going to give you money? It's only the people who can trust you, but also the ones who are going to get good return. So that return, we're going to be talking about it in a minute. How it is, how do you define it, etc. Okay, so that's really, if you, Abdulkader, if you want, we're going to the how to raise the funding.
Yeah, absolutely. We have a question here, if you don't mind.
Okay.
Yeah, we have a question here from Samir. So thanks a lot, Professor. My question concerns the difference in terms of life cycle between startup, SME, and big companies. The specificity of startup in the first stage.
So the specificities?
The specificity of startups is in the first stage.
Yes. Well, so if you look here, I put some specificities here. I didn't want to go too much into details, but I can try to explain them. So when you are at first stage, as we said, your company is really very, very small. It's very young. It's only maybe 1 year of age, or maybe it's 6 months of age, etc. So the type of company is the type of startup is likely not to have lots of facilities. It wouldn't have infrastructure. So as I said, I mean, there are some people who started their business in the shed or in a corner of their house, or they don't have even a specific building. But they have the idea that counts. So it is an intangible asset that they have there. The tangible asset is relatively small. Unfortunately, the providers of funding, in particular banks, they look more at the tangible assets, and they look at the assets that are not depreciable and that are redeployable. And usually they look at your house. They will take your real estate, what you have as a property. That is the something that they will take as guarantee against what they give you as funding. The venture capitalists, they don't have obviously the right to have a gauge against your real estate, but they may ask you for higher return because of the risk that they are taking. So those startup stage, there are businesses that do not have lots of assets. There are businesses that are very young. There are businesses that are very high growth. That are businesses that are small, and there are businesses that are much more likely to make losses. There, when you start as a startup, you don't expect to sell lots of products and to generate profit. There are really they are at the early stage, therefore they are making losses, and they wouldn't have that internal cash flow that we mentioned earlier to finance their activity. They are much more likely to go outside. But as you move on to rapid expansion, that is when you start growing, to have some assets, to probably to just start generating profit, to be relatively large, etc. Then in which case you are likely to come as an IPO in the market. When you are at maturity stage, that is really where you are boring company. You don't grow, you are just there, and therefore you are likely to be financed with debt because you have got lots of real estate that you can use as collateral, or you are listed in the market, you have some shares, etc. So those kind of the differences across those businesses is a function of number of factors. So when you look at particular business, you try to analyze the business from those different factors. Like, as I said again, it's the size of the business, the age of the business, the growth rate of the business, the profitability of the business, and the type of financing that business has, which is much more likely to be in the form, when you are startup, much more likely to be in the form of equity rather than debt. Okay.
So I think, yeah, I think part of the question of Samir, it has a little bit, it's kind of bring us to the difference between startup, or the specification of startup and SME. So a
Yeah.
startup actually a small business at some stage, and the small business is a startup at some stage. So startup is part of the SME world, or the SOHO. They call it SOHO, small business small office, SOHO. Yeah, small office, home office. So I think it's kind of difference between both. So we have another question here, um, from Mehdi. Every investor already arrives with his exit strategy. Should we set the term from the start? I mean.
That's an excellent question. We are going to come to that in a minute when we talk about those stages. It's definitely when you have those investors that are in particular the venture capitalists or the angels, their objective is to exit, is to stay with you for a number of years, maybe 2 to 3 years, depending. I mean, for angel, depend nowadays. I think the average kind of holding of venture capitalists and angels might be about 8 to 9 years, because the market, their best exit strategy will be the IPO, is when they bring you to the stock market as an initial public offering. But given that the market nowadays, in particular with COVID-19, is really running down, we have a big problem that they cannot exit very quickly. So in general, they stay in a little bit longer in your company. But this exit strategy, you'll need to discuss it up front, and that is what we are going to discuss in a minute, about those different stages, in particular in stage 3, where you negotiate the deal. And part of that negotiation of the deal will be the constraints that they impose on you, but also the exit strategy that they will have.
Mhm. Well, I think we can take another question and move to
Yeah.
our question later on. So it is good to highlight the raising funds for early stage projects, especially IT startups. So it's like how raising capital is happening for IT startups.
Can you go for this, Katerina?
Yes,
Katarina.
so I think the specificity, the process is the same in terms of for any startup. What is specific to IT startups is everything related to revenue streams, which is different to companies that, for example, manufacture products or are in agricultural. So everything that is related to investments in heavy machinery or produces that you need to keep your production going. IT is based on services, meaning that your revenue streams come from services that people provide. So there's no like tangible assets, which has an impact on the way your company is valued, which has an impact on your balance sheet. So everything that the professor explained a bit earlier in the meeting is impacted by the fact that you are a service provider and not a company that provides products. And all like, as the professor says, the financial data is the backbone of the company, and as such, also the backbone to your fundraising strategy and your fundraising process.
Yeah, I want to add something here regarding IT startups, or as Katarina said, it's the same process. It's the same process. However, the most important things for startup is the traction. So wherever you have a good traction, wherever you have a good focus and solid customers in hand, so this is will make a difference. So it's IT, or I don't know, another another business kind of business. It's all about traction. So whatever you can show, you can make your traction visible to everyone and very solid. People will be attracted, and then they will invest accordingly. So that's the trick.
That's excellent concepts here. As I said earlier, the businesses, they can be classified also into whether there are the kind of whether their product is something that is tangible, is something that can be produced and we can touch it, or intangible. IT is intangible. Is your product, unless if you are producing hardware, which is different. But I guess that for this question, it's much more about the software or the application that you are developing. So that is really where the risk is probably higher, because what you are producing might go in the market or maybe copied by somebody else, etc., instead of producing maybe a product that is difficult to copy or something like that. But let's go now into this stage. The stage one is really where all those questions are related to. Is it because in the stage one is critical for any business, because that is where you are going to try to convince those providers of funding to invest in your business. You think always that when you are an entrepreneur, you are a beggar rather than a chooser. So the angels and the venture capitalists are the one who are going to choose you rather than you choosing them. So the first thing that you need to do is to present your business. What do you have in your business? There are three main factors that will contribute to getting the funding. The first one is the product that you have. So what type of business you are in. So for example, for this last question about IT, you need to present exactly your product. What do you do in IT? Because IT is too broad. What is the application that you are going to that you are developing? How many clients are you going to have? Is there a competition? Can somebody do it? In other words, can they copy it or something like that? So it's all to do with the product that you are developing, and then you are seeking to get funding for. The second factor that is critical in raising capital is the fact that those angels or venture capitalists are going to be interested in you. You are the one that they are going to finance. So consequently, any good CV that you have will be very, very important. So in particular, if you are successful in another business, you created one company, it worked very well, you sold it or you brought it to the stock market, that will count a lot, because that will say to those investors that this guy is this person, not this lady or a man, is very, very good in the sense that they created this business, they were successful, etc. The third factor that is very critical is what we refer to as the windows of opportunity, in the sense that it depends on the time period when you go to get the funding. In some time periods, a particular investment ID will get you the funding. In other periods, they won't get you funding. So currently, if you go really with an oil exploration company in ID, very, very unlikely to get funded. Why? Because oil prices are going down. The oil industry is not really, we don't know whether it will exist in 10 years time or 20 years time or something like that. So really kind of the kind of the likelihood of getting funding if you go with an ID like that for raising capital to finance oil is very unlikely. But in contrast, if you go with the idea that you are going to create a vaccine for this COVID, or a biotech company, or maybe some specific software to do something, or maybe artificial intelligence, that is probably where you are going to get the funding. So those three factors: product, your CV, yourself, your experience, and the windows of opportunity are really very critical there in this stage one, to get the funding, to present your company, and then to get funding.
And which is the most critical stage, by the way. Yeah. So we have another question: how we can estimate or predict the risk at this time, or I mean at early stage? He means, I think.
Yeah, I will discuss in a minute, if you allow me, Samir. In a minute, I will discuss this kind of risk element, which is going to enter the definition of the required the rate of return that those investors are going to expect from you, or what we call the expected rate of return of the venture capitalist. So if you bear with me just a minute, I have the next discussion will be on valuation, and then we'll be talking about this cost of capital. And I will try to kind of put within a context your question. Okay, Katrina, do you have anything for this stage one from your experience?
Sorry, I didn't hear that. The connection just went off. Can you please repeat?
So sorry, it's just for this stage one where you provoke the equity investors' interest. So how do you pitch the venture capitalists or angels in
How
your
do you pitch it?
experience?
There are a lot of things that you can do to prepare this stage. I think I want to emphasize on one thing because we're running a bit out of time, which is having a relevant pitch deck. And having a relevant pitch deck requires a lot of preparation, a lot of time. I always tell the people, go online and do research on pitch decks, because this is really like the CV that gets you in the door. If they have a look and in like 30 seconds they're convinced by your pitch deck, they will talk to you. If they are not interested in your pitch deck, they won't talk to you. You don't get a second chance.
Yes.
So this is probably the one thing that I want to emphasize on in this stage. There's a lot more to say about this stage, but once again, we're running a bit out of time, so I just want to leave the time to the rest of the webinar.
Yeah.
Okay,
Sure.
so if I can go into the valuation very quickly. So really kind of this is, I want to spend a bit more time, but I realized that really the time was running. Sorry for that. But really, this is kind of
3 minutes, Professor.
3 minutes.
3 minutes
Okay.
to go to valuation.
Okay, very quickly. When you go and raise capital from venture capitalists or angels, they're not interested in the dividends that you pay them now or in the return that you are going to pay them this year or next year. They are much more likely to be interested in the future. In, say, 5 years' time, what will be the exit value? So one question was about the exit really issue. That is really where it is important, that when they do the valuation, they're not thinking about what they can get in the next 2 years or 3 years as cash, because you are less likely to pay dividends. You are much more likely to reinvest any profit. If you generate any profit in your business, to reinvest it directly in your business, because you are at growth stage. So they will look more at 5 years' time. They will estimate your what we refer to as the earnings. So say in 5 years' time, I just put here an example of 5 years' time. So in 5 years' time, what will be your expected earnings? So they will discuss with you, they will forecast, etc. So suppose that they know that they are going to you are going to have 100,000, say, as earnings in 5 years' time. Now, the next stage is to get a price-earnings ratio of companies that are trading in the stock market in that industry. So if I can just show you very quickly I'm not sure whether I can show it to you, but I want to show you the Financial Times. So if I go into a page of the Financial Times, I hope you will be able to see it and it works. Come on. So they will go just as an example here into one page of the Financial Times, and then they will give you the price earnings ratio of that particular sector. So sorry, I think it will take some time to work it out. So in which case okay, it's coming. So that is really the price of listed companies in that particular industry where you are relative to the earnings. So what we refer to as the P ratio. Then what we do is that we multiply the P ratio, by the earnings that you are going to generate in 5 years' time. So really this is the page that I want to look at. So every day it is on the Financial Times. It's called the FTSE. Actually, it is share indices. So if we go here into say the healthcare. So if I take those healthcare companies and I go into their PE ratio, you find at what price relative to the earnings those companies in the healthcare are trading. So that is where I took this 50. So healthcare. So I have 49.86 here. So I just put it as 50 for simplicity. So I will take this 50 or 49.8 or something like that. I will multiply it by 100,000, which is the earnings that you generate in 5 years' time. I get your value in 5 years' time of 5 million. Okay, so if you were really listed now today, this is what I expect for your business to be valued in the stock market. Now, suppose that the entrepreneur now would like to discount those 5 million to times zero, because we are in 5 years' time ahead. We want to know the value of today. So this is what we refer to in finance as discounting. And the entrepreneur will ask maybe for discount rates, say, of 15%. If we do this, we get the value today of 2.5 million. Now, if the entrepreneur is going to ask, say, for 200,000, then the stake that you are going to give, that the entrepreneur is going to give to the venture capitalist or the angel, will be 8%, which is the 200 that you are asking, 200,000 that you are asking for, divided by this value of 2.5 million. So that gives you 8%. But the entrepreneur is not going to be happy with this with this 15% return, because they will say, why should you invest in your company? It's startup, it's very risky, etc. I'm not going to invest in your company for 15% return. They are likely to ask for 55% return. So really above 50, very likely to be above 50%, in which case the value of your company will be only 558,000. And for 200,000 that you want, you need to give up 36% stake in your company. So you end up only with 74% ownership in your, 74% ownership, and you give 36% in your company. And for 8%, if you want to give up only 8% in your company, they will give you only 45,000 instead of 200,000. So this is a really kind of, I'm sorry if I'm running a bit out of time, but as I said earlier, if you want more details, I'm happy to respond to any of your questions. So this is really what we refer to as the venture capitalist valuation method. And this is critical in all negotiations that you are going to have, because once you do this valuation now, you need to negotiate the deal. Would you accept those 38 to give up 36% in your company to get 200,000? It's maybe big stake that you are giving in your company. The angel or the VC will set up some restrictions that you cannot raise additional money because they will be diluted, their ownership will be diluted, etc. They're very likely to sit on your board. So to take active role in your company, they sit on your board, they will discuss whatever decision that you are going to make. They may even have some conflict with you. Maybe they may be risk that it's not going to work out, in which case you need to pay them back. And this exit is usually, as I said, in the form of IPO, which is the best exit that you could have, IPO or trade sale. So in other words, they will sell you to somebody else, to another venture capitalist or another angel. So that exit is always, the question came earlier, is always in the mind of the investor, because they don't want to be with you for very, very long. There are relatively medium-term investors that would like a higher return in financing your business, and the exit, hopefully they will get even much higher return, especially if they exit through initial public offering.
I have a question here, Professor, and
Please,
I think it's a very basic question, and it's a little bit tricky for entrepreneurs, which is the pre-money evaluation.
yeah.
So usually startups, when they're gonna trigger the first investor, venture capital, or even business angel, they want usually they double the amount they have, or the revenue they have. Usually this is the way. They do not hire expert because they're in early stage, which is very expensive. So what is the easiest things they can do to give a fair valuation at pre-money stage?
That is a very good question. In general, we look at similar companies. So if there are some similar ones that are not directly in the same product, but very, very similar, and they pass this stage, say, of raising capital from venture capitalists, and they have this information, they probably base their idea about the value of their business on that experience that their friends or a kind of competitor had. But it's also very, very important really to know some of those notions of this valuation method, that the VC valuation method that they can find on some books, or some, if they go into the internet, they just put a VC valuation method. I think there are some on YouTube. Maybe they would explain a bit more. But again, as I said, if they want a bit more information, and I went a little bit kind of quick here, then they can contact with my email. But it's obviously quite difficult. But you need to be prepared. Very important to be prepared about the value that you would expect for your company. Don't be too optimistic, but at the same time, don't be too pessimistic. Is really kind of getting valuation that is relatively in the middle. There is no single method. There is no single kind of to say that my company is worth 1 million and that's it. No, that's really by doing some more computations that you would get proxy for the value of your company. And then after it is negotiation with the angels, if they are willing to discuss, because usually they say, no, this is what we want to give you as money, this is what we want to take as stake in your company, take it or leave it. So it may be very bit difficult to have a discussion with them about this. Yeah. But try to negotiate as long as you are well prepared.
We have question here, Professor. How to choose this interesting? How to choose a discount rate?
Okay, so that's thank you, because I need to reply also to that question of Samir earlier. So that 55% or this 15% includes really 5 factors that are important. The first one is the risk-free rate in your particular country, in your particular economy. The risk-free rate is what you get as a, to put it simple, is what you get as a interest if you put your money in a deposit account. Really, what we take effectively in practice is for the government, the yield on the government bond. So when your government has issued some bonds in the market, they will be trading at particular price and they will be yielding a particular return. That is the yield that you take on the government bonds. So that is the risk-free rate. Then you add to this, so suppose that nowadays, say in the US, maybe the risk-free rate is 2%. Then you add to this a premium for risk, for the risk of your business, that will include 4 main factors. The first one is the product. How risky is your product? In other words, that if you have a cyclical product, then it's very risky, because the turnover is not going to be the same. When the economy is going, your turnover will go up, but when the economy is going down, the turnover will be down. But if your product is non-cyclical, and like, for example, the question earlier about the IT application, and if it's going to be used anytime independently of the macroeconomic conditions, then that product is non-cyclical, so it is relatively lower risk. So that is the second factor, is your product. Then you look also at the industry. What is the competition? How much market share that you have, etc. The third factor is the financial risk, is how much debt do you have in your business. The higher the amount of debt in your business, the higher the financial risk. Therefore, the higher the discount rate that those VCs or angels will ask you for. The fourth factor are the macroeconomic risks. So the extent to which your business is subject to interest rate risk or exchange rate. So for example, if you export all your products abroad and there is a kind of exchange rate that is changing, then there is a big risk for your business. And the final one is the political risk, is to the extent to which in your country you have stability, you have the property right, you have the investor rights, etc. So anything to do with really the government kind of doing something that is going to harm that business, and therefore you as the angel or VC is going to lose your money. And that is how we can take in all those factors into account. There are a number of applications that we can use to quantify them, because I'm just trying really to go quickly because of time constraint, and also but there are a number of models that you can use in order to end up with this, say, discount rate of 55%. Maybe if that entrepreneur is in another country, the same business, everything is the same, they probably the angels may ask only for, say, 35%. Why? It's because there are another country where there is more disclosure, where there is the less political risk, etc. So those are really the 5 factors that you need to take into account when computing this discount rate. It's a function of the risk. So this is the expected return. So in other words, the angels will be expecting the return to be 55% of the money that they will put in. So the return that they will get when they exit. In other countries, it might be less. In other countries, it might be more. If the political risk is very high, therefore they will need a higher return. Somebody told me that in some Eastern European countries, they ask for up to 80 to 90% discount rate. So really, you change this into 80%, and then you can see that the value of your company will be only 264,000, and therefore for 200,000 they will take 76% stake in your company. Okay.
Absolutely, yes. We have a question. The next question is, how would I negotiate an exit of an angel or venture capital?
Can you go to Katrina on this? Maybe you had some experience.
So I don't like to give general rules on negotiation, because negotiation is always a very individual process, right? It really depends on the initial agreements that you had with the angel investor, how the relationship with that investor has been going on during the time, what are the metrics that you can put on this investment. So there are like several factors that you need to take into account when you negotiate the exit of an angel investor. Who comes instead? Is the entrepreneur buying back the shares? Is there a VC fund that takes the place and invests a little bit more? What is the valuation of the company at that point in time? So there are like a lot of factors that come into play, from the preparation of this angel investor to the state of the company when he entered or she entered, to when that person left the company. And what I always advise entrepreneurs to do when they take on board angel investors, project this trajectory as much as possible. You can't really see all the different details, but as long as you have a financial planning, you can also plan for the exit of your angel investor.
There is also a time dependent that if, for example, the economy is doing well, the stock market is doing very well, I mean, probably if you want to come as an IPO, that is really where you time that you take that opportunity. You tell the VC or even the angel that really it's time probably to come to the stock market and have an IPO, and that will be ideal probably for you, in particular if you don't get on very well with the angel or the VC, and also they will get you will attract them a lot by saying, no, you are going to generate very good return because the market is going very high. There are many IPOs, similar IPOs that came, the same characteristics. They were very successful. You look in particular at the price they come in relative to the price that they were trading on the first day, what we refer to in the literature as the end pricing. The higher that difference between the two prices, the more likely that they are willing to come to the market and to bring the company as an IPO and to be able to exit.
Great. So the last question is, what do you see as the main problem of an angel VC in emerging market? So what is the common problems? of yeah.
There are a good number, just very briefly again because of
Be
time.
soft,
You have really those risks. Think about those 5 risks that are the 4 risks that I mentioned to you. So the risk-free is just, the risk-free is really the more the economy in the emerging market is not doing very well, the higher the risk-free rate. Therefore, if already the central bank maybe is, or the government bonds are offering, say, 10% return, what would really make those angels and venture capitalists invest in your company? They would say, no, with say 10% return, I'm happy. I don't want to invest more. But obviously there is the inflation, etc., that would explain that risk-free rate. But the really the most important ones are the 4 risks that I mentioned. So in emerging market, the product is very difficult. The product is not protected by the intellectual property rights. The product can be copied by anyone. You might have even difficulties in having even that balance sheet that I mentioned to you earlier in terms of your assets that really belong to you. You might have some land, but you don't have a registry. You might have a building, you might have a house, but you don't have the building construction. You might have any assets that you have there may not necessarily belong to you, and that is a big problem, because if you don't own them, the angel and the VC are not going to put money in the company that doesn't have assets. In part, the debt holders will be the same. So that's really the issue about the product, the extent to which you have a company, the independent with its assets and equity and liabilities. So we can identify them clearly, that we do due diligence, because all those angels and VCs, they do lots of due diligence. They cannot give you only money like that out of the blue. They need to know that whether you have all those assets that you have proposed in your the pitch desk, or the pitch deck, sorry, or in your prospectus, etc. The second one is this financial risk. To what extent is the banking sector not going to push you into bankruptcy easily? To what extent can they be a bit lenient with you? So therefore, the more they can give you some free time to recover, to get funding, to pay them back, rather than declare you bankrupt, the more likely that they will attract those angels, and your risk is going to be relatively lower. The third one is this macroeconomic risk. To what extent is the government for example, manipulating or managing the exchange rate, or reducing the risk of your exchange rate, or is it kind of a floating rate, in which case you take the full risk? And finally, the most again, in emerging markets, one thing that is very critical is this political risk. So political stability in the country will help a lot those startups to get funding and to grow and to prosper, and to be companies that are really that will come to the market, and that will create value effectively. I hope I answered your question, Abdulkader.
Yeah. So, going back to the asset, you spoke about the asset and so on. So I think for startup or for investors, they want to look for always for a quick liquidated asset, because in case of problem, they want to get a money first, and
Yeah.
there is a lot of negotiation here, so they can get priority for them to get a money first, and later you. So it's kind of the liquidation. How do you see which assets are quickly liquidated? I would say technology, because it's information, is profile, is data, so it can be liquidated quickly. Is there something else about this liquidation?
Well, we need to make first of all difference between, as I said earlier, the tangible assets and the intangible assets. So for debt holders, what is really the most important is the tangible assets that are not depreciable and that are redeployable. So those are the two characteristics that we discussed, in the sense that they are not depreciable. It's only land and building. And those land and building, they can be redeployed for something else. So you imagine that you have got kind of a place where you're a factory, and then the company is not doing very well. Then normally the debt holder, or even those shareholders, they will try to see the extent to which that building can be sold on your name. You have got the right to sell it, not only the right to use it, because you could lease that building, it doesn't belong to you. So therefore, when I look at your balance sheet and I see that most of those assets that you have are leased assets, they don't have value for me. They belong. You as the entrepreneur, you have the right to use them, but not the right to change them or to sell them. They don't belong effectively to you. So for a debt holder or any investor, really those tangible, redeployable, non-depreciable assets, which are the real estate, is very critical. They're not going to be interested if you have got car, or unless obviously if you have got Ferrari or something like that, then it might be very important. It might keep its value, but apart from the car is depreciable asset, they won't take it. They're not going to be interested too much in what you have as stock of the products, because you are distressed because you cannot sell those products. So those products effectively have zero value there. Now, the other issue that you mentioned, which is very important, is the intangible asset. Intangible asset, so long as you have got license for it, so long as you have got a brand name, license, and intellectual property, that has got big value. Because then if something happens to you, then you can take that license and sell it or rent it to somebody else, etc. But if you don't have those, if you don't have brand name, if you don't have this license or intellectual property, then that intangible asset value is really relatively zero. But what is really having value is the tangible, that is real estate. That is critical.
All right, all right. You want to add something, Katarina, because we reach up to an end here.
No, I think we're good. I think Professor has largely covered the subject.
Yeah, he covered a venture capital course at all.
But I tried to squeeze about 2 days
Yeah,
of course into 1 hour and a half.
I know. If we continue, that's gonna take ages. 3 hours or maybe. Now we are an hour and a half, which is great. I think we reached up to the end of this webinar. So, by last but not least, I will thank Professor so much for his enriched, discussion and explanation, and I hope it brings value to you. And of course, Katarina, thank you for your time, for being with us tonight, and we hope to see you next time. So, have a good night.
Thank you,
very much.
for organizing this. Really
Thank you.
enjoyable.
Okay.
Thank you very much. Bye-bye.
Bye.